How to read and analyze a balance sheet for beginners. Ever look at a balance sheet and think, what am I even looking at? We want to solve that. In this video, we'll break it down and let you in on the numbers that actually matter. What is a balance sheet? Let's start with the basics. A balance sheet shows three key things: what your business owns, your assets; what it owes, your liabilities; and what's left over, your profits or equity. And as they say in accounting, assets equals liabilities plus equity. Balance sheet is there to make sure that your numbers add up. Let's talk assets. Assets are what fuel your business. They are the resources you rely on to operate, grow, and stay afloat. And they're usually split up into two categories: current assets, cash, accounts receivable, and inventory; non-current assets, property, equipment, and long-term investments. Pro tip: a healthy business should have enough non-current assets to cover short-term liabilities. Liabilities. Liabilities are your company's debt. And yes, every business has them. They're typically split like this: current liabilities, short-term obligations like suppliers' invoices, tax payables or wages; long-term liabilities, loans, leases, or anything due after 12 months. A red flag to watch out for: if your current liabilities are growing faster than your current assets, it could signal cash flow trouble. Onto equity. Equity is what's left for the owner after debts have been paid. Positive equity means there's value in the business. This could include retained earnings, owner's capital, or stock if you're incorporated. And negative equity is a warning sign. It means that you may owe more than you own, and that you might need to rethink your financial strategy. How to lay it out. Your balance sheet is typically laid out in two columns: assets to the left, liabilities and equity to the right. At a glance, you should be able to see your business's financial position. Quick tip: always check for basic errors, like mismatched totals or outdated asset values. Things like stale inventory numbers can throw off your entire financial picture. Spot red flags fast. Use these formulas to stay on top of your game. Your current ratio. This is your current assets divided by your current liabilities. A value above 1 means you're good to cover short-term bills. Your debt to equity ratio. This is your total liabilities divided by total equity. A higher ratio means higher risk, especially if your cash flow is tight. A balance sheet gives you a snapshot of your business's financial health. When you know how to read it, you can make smarter decisions, spot risks early, and plan for growth with confidence. Want to simplify the process? There's accounting software to help you automate your reporting, so you'll always have clean and up-to-date numbers at your fingertips. Need help analyzing your balance sheet or setting up better financial reporting? Our CPAs can help.